Very good afternoon, everybody, and thank you so much for joining in. My name is Ganesh from HDFC Securities, and I welcome each one of you to this webinar. The topic for today's discussion is PMS, that is Portfolio Management Services. We are currently seeing a lot of volatility. There is a lot of uncertainty that is there in the market. But amidst all this volatility and uncertainty, what are the kind of opportunities that we as investors have today? What is the what are the impact of the current events and what is the way forward? To throw more insights on this, we have with us two distinguished gentlemen from ICICI Prudential AMC. The first being Mr. Parag Thakkar, who's the Senior Fund Manager with ICICI Prudential AMC, and Mr. Devi Prasad, who's the Business Head, again with ICICI Prudential Asset Management Company. Parag and Devi, thank you so much for joining in, and it is all over to you now.
Thanks, Ganesh, for having us there, and thank you very much for this opportunity. So as you rightly mentioned, today we are into a scenario where there is a lot of uncertainty, and we would want to just run through the presentation. So I have with me Parag Thakkar, who's my senior colleague and portfolio manager for the ICICI Prudential Contra PMS and Pipe PMS, and the agenda is today that whenever we've been talking to investors, or we've been talking to our distribution partners, pretty often we've been getting a query that what do you feel will happen, right? And the second query is that when do you see this settling down? The third query is that when do we see the portfolio recovering, right? While both of us have limitations in terms of forecasting the market, that when will this settle down, right? Today we all are inside our house, we are sitting at our houses, and we are doing these webinars and presentations. So while we have our very limited options in terms of ability in terms of forecasting, that how do we see the market ahead. But what we have done is, and what we have put up for you, and we've been talking to our investor, is from the lenses of our investment philosophy, right? That what do we see and how do we see the market from the lenses of our investment philosophy. So let me run you through quickly before I hand it over to Parag to take us through further market inputs. Let me quickly run you through what we have done and which can be pretty comforting to you all. So so the first let me first touch upon the framework which we use at ICICI Prudential PMS. So at ICICI Prudential PMS we use Core 4 framework, which essentially has four legs, so which essentially has 4 parameters, which is further divided into various other parameters. So the first parameter is business model, which obviously any fund manager who's picking up a stock in the portfolio would want to invest in good businesses, stable businesses, and also businesses which are generating higher cash, right? So for us, it becomes very important in terms of the cash conversion or the free cash flow generation are two larger parameters, a part of the intent of the business owner, right? So for us, from a business perspective, while I will touch upon it on a slightly later slide, in detail, the business model, but these are parameters which is important, a part of the business owner's integrity levels, right? But other 3 parameters are the parameters where our entire discussion is focused upon today. So the valuation, sentiment, and theme, which essentially starts from themes, which is a macro, and then macro, changes in macro derives the sentiments or changes the sentiment in the market, and then obviously it has its own impact on valuations. So if you look at all these three things put together, what comes out is that while valuation can be very attractive, there has to be a positive sentiment for a price discovery to happen. So at ICICI Prudential, what we believe is that while valuations might be attractive, it needs a positive sentiment for the price discovery to happen. So our job is to ensure that we buy good companies, clean companies into the portfolio, and zooming upon the valuations parameters of ours. The two things which are of paramount importance, and in today's scenario, as we move on the slide, we'll touch upon that more. Two things which are very important is it's actually out of one particular parameter, which is the leverage, right? That what kind of leverage a company runs into their balance sheet. So while we say that valuation is very important, people have their own matrices to gauge the valuations. Some people look at enterprise value to EBITDA, some people look at price to earnings, some look at the standard measure of price to book value of equity, right? While those can be definite measures, but there are two things, which is net debt to EBITDA or debt to equity, or or the interest coverage ratio, which is what times of the finance cost your earnings are, right? So that's how these are three parameters which we look at. So what we thought is that while debt is low leverage is the key to the great lockdown. We believe that in the past cycles we did a simulation, and what came out is that debt is detrimental for and having higher debt is even more detrimental for any portfolio. So what we did is we ran our portfolios through from the lenses of our strategy. We ran our portfolios through the debt, what these companies would have done in a crisis scenario. And this is how the results were, right? So we ran an analysis on the companies which would have had higher leverage on their balance sheet vis-a-vis a company which would have had a negligible or zero leverage in the balance sheet. And what we saw is and we took a sample period of 2007 to 2009. Right now, why we took that period is essentially because that was a crisis scenario. Now that crisis was triggered and by an event which was also a financial market event, but it rather it started from a housing market and then ran into a financial crisis, right? A global financial crisis. Similar scenario is today, that the event has started from a disease, which is a wide viral disease, and then it is running, or it is sort of running into a financial crisis, right? So how does companies which has leverage react during the financial crisis? What we tried evaluating, and the results were pretty satisfactory, as we have anticipated. We have which made us make that part of our core 4 philosophy. The results were also on the similar lines. So you can see yourself that the companies, those who had very high leverage on the balance sheets, have fallen. Number one, when the market were falling, had fallen higher, and then has also recovered lower compared to the companies those who had low leverage. So if you look at the 2-year followed 2-year or 3-year return, you would have seen a very high recovery in a company which have got low leverage, because they obviously have much higher cash. They have less debt or finance cost. Their ratings are stable, so they can borrow at a cheaper cost. The cost of borrowing is cheaper, etc. So all these implications are positive implication of having a low debt. Now, while you might say that these are best names, these are MNC companies, here are some domestic companies also, and the results are same. So the result of the simulation doesn't change, right? You take good companies, you take bad companies. The one who has got leverage is has a higher impact and negligible impact vis-a-vis the those who don't have debt on the balance sheet. So that's one analysis we wanted to share, which can sort of give you a confidence that okay, this is something which is coming out today, that the companies which have got stronger balance sheets are the ones who will sail through this period of time. Now, coming to the valuation. So while debt is one part, valuation wise, you look at that today valuations on a price to book basis is pretty comfortable valuation, right? We are trading much below the historic average price to book value, so it is a much comfortable valuation. But still, we haven't seen that kind of a market impact or that kind of a price action coming in, right? If valuations are cheap, then logically everyone should have piled onto the stock. People should have bought, and that should have changed the demand and supply equation, and that should have changed the prices of the stock. But it has not happened, right? So why it has not happened, is essentially because of the negative sentiment. This is what we were talking about, so that also reinstates our point, which is part of our core four, that sentiment has to turn positive for a price discovery to happen. Now, how would that happen, right? So whenever there is a crisis scenario, what runs faster, right? So what is the measure any government or any central bank takes is, they so this is in extension to the slide which I was talking about, which is valuation. This is about sentiment, that what drives the sentiment. So this gives a more elaborative explanation of sentiment. So you look at periods where sentiments has been negative. You have seen the predominant contributors who contributes predominantly to the buyings into the emerging market, like FIIs or FPIs. We have seen those negative outflows coming, right? So those are larger monies, and you see this one, the this uh, uh, COVID-19, right? Especially, or you look at the demonetization part, you look at the global weakness, right? 15 to May 15 to November 15 period. You look at the demonetization period. You look at the US Fed rate hike period, right? So all these periods, rate hike, and all demonetization, all are a period where there is a stress on cash flow, and physical assets, physical financial assets being sold, and money has been bought back. So they buy back the liquidity, they sell the financial assets, and that's where the prices of financial assets actually come down, right? So how does this recover now? How does this sentiment change, right? This sentiment change with infusion of liquidity. So what is the measure the governments and RBI or the reserve banks globally world over take is they change the monetary curve, right? So they do the shift by changing the liquidity curve, right? So they inject more liquidity into the system, which brings down the cost of capital, and that makes more people borrow, invest into their business. So it makes a business environment conducive, right? So liquidity is something which has a very high correlation with equity market index. Now in this context, we have taken the most riskiest index, which is the small cap index, because since some of you would have been would have invested in the small cap PMS also, right? This has a very high correlation with the risk asset. So the highest riskier asset in terms of the financial market or the equity investing would be the small cap asset, right? So we have we have shown a correlation, and this is for last 15 odd years. The correlation is which has covered good amount of rate increase and rate reduction cycles world over. It shows the correlation with the of interest rate with the riskier asset, that with a lag effect the business environment improves. And as I said, why it would improve is that everything, money is money runs in front, right? So cheaper money will reduce, while cheaper money will ensure that there is a spur in the growth, which will entail higher revenue realization. It will also lead to reduction in the cost of borrowing, renegotiation of cost of borrowing, right? All these things which will have its own impact on the EBITDAs, and then on the net income, and then also on the cash conversion, which eventually discounted into the stock price, right? So that's the implication which happens, right? So it has implication on the credit rating, it has implication on the overall balance sheet, right? So that essentially is what we are trying to showcase, that it has a correlation, and that's why we believe that the riskier assets also with the lag effect starts doing well. And that is what we had seen in the recent past. If Corona was not there, we were in a up cycle, right? So there was a rate reduction cycle which had begin world over, so starting from US and then followed by a Reserve Bank in India, right? Which monetary easing had started, and that would have led to a rally, and then a tax cut fueled that thing. So that would have led to a sort of rally which we had seen September till Feb, right? If Corona wouldn't have happened, we would have been sitting on a much higher gains at this point of time versus the the drawdowns which we have taken. So we did another. So to give you a comfort, while I've been talking all this, the next question is that how much would be the fall? What kind of fall would be there, and what would be the recovery per se of the portfolio, right? So we did another simulation because we've been talking about that business is very important in our perspective, right? We also since macro, we give a lot of emphasis to macro in our investing. We also give too much of emphasis to the cycles, right? The business cycles. And when the business cycles comes to perspective, we have to have we have to own business, right? What the way Parag says, and Parag will explain, we should own business, those who have gone through various cycles. So those who have seen at least 2-3 cycles have sustained through that, and essentially the management is the same management which has sustained through those cycles and have performed during those cycles and have come out of those cycles very strongly, and have sustained in during those cycles and have come out those cycles very strongly, and ran the businesses to success, right? So that essentially we intend to. So that's where I said that I will touch upon this aspect towards a slighter towards the end, right? That that's how that impacts us. That business owners and businesses has a relevance to our core 4 philosophy. So we also did another study where we did an analysis. So here is a thorough analysis of whatever I spoke so far, that you would have a question that while you spoke that interest coverage, you spoke about net debt, how is your portfolio positioned? So you look at the net debt to EBITDA level is 0.7, the debt to equity is 0.3, and the interest coverage ratio is 83x, right? So which is a very, very high level. So we look at net debt to EBITDA of less than 3x at a portfolio level. That's how our endeavor is. But here the weighted average net debt to EBITDA of the portfolio is 0.7x. The interest coverage ratio we look at, companies should have more than 7x. Here we are talking about 83x. So from a balance sheet perspective and from a lockdown perspective, I think it is the portfolio where an investor should be present, because these are the companies who have got higher realization, they have lower debt, lower leverage, and they would be the great, they would be the key to the great lockdown in terms of investments, right? We also did another study where we said, okay, fine, while we have all this portfolio, how this portfolio would have performed if it was, a period where there would have been a lockdown or a financial crisis, and then how this portfolio would have performed. So we did a stress test of our portfolio in the past cycle. So since we said that these companies have the companies which are part of the portfolio predominantly have been there, and they have seen cycles. So we said that how these companies have performed also during those cycle, and we took 2 sample periods, right? So when you do back testing, you can take samples of the period which has more correlation or relevance to the current environment, right? So an event leading to a financial crisis, event which was a housing bubble leading to a financial crisis, right? World over, today a corona event leading to a financial crisis world over, right? Only thing is, which I will talk the risk towards the end, which is corona, right? So we will touch upon that just in a while. But at this point of time, look at this, right? The fall, while 2007 to 2009 period we have taken, While these companies would have participated in the fall, the recovery on a 2 to 3 year time frame would have been much stronger. Similarly, the 2010-11 period, again we have taken a sample which is just after the crisis, and then there is a dip which has come in. How the companies would have performed, again they would have participated in that fall, because when the broader market fall happens, no one is spared, because you are correlated to the broader market. Every business is correlated to the economy, and if there is a run on economy which comes in, everything falls. So we are also not spared. The ones who claim that they will not fall, I don't know what reason they have, but there is no reason that why a company cannot form. Best of the best businesses can take a beating at this point of time. The essentiality or the velocity of or the magnitude of the fall uh, mm, can be subjective, right? Can be dependent on the beta or the correlation which they have with the broader index, right? So everyone takes a beating, but when the recovery happens, you look at the companies, the portfolio companies, as I have shown in the previous slide, of where we have evaluated vis-a-vis the debt companies, leverage companies, the portfolio of contra portfolio would have also done very well. So this should give us a lot of confidence that our philosophy, our ability of picking right stocks, and our ability of our philosophy or our lenses of investing are strong enough to protect or or pick stocks which can you know uh, which can deliver these kind of returns in the when the recovery comes. So essentially, the point which I'm trying to make here is that while we would have participated in the fall, we have participated lesser than the market, which you can see in the performances, right? And when the recovery will come, so say in April month the recovery came, we generated about 7% higher than the market, right? So the alpha was also there. So while falling, we had fallen less. While the recovery came, we gained also higher. And we believe the past data shows, if we have to take cues from the past data, then we will recover also much faster, right? Similar study we did for pipe strategy. You look at the net debt to EBITDA is 0.2x, the interest coverage ratio is 156x, which is a very high quality portfolio in terms of a small and mid cap portfolio, right? Generally small and mid cap portfolios have very high leverage and their interest coverage ratios are much lower. But in this case, we have companies where the interest coverage ratios are much higher. And similar study of this, the stress test of these companies through past cycle, you see yourself, the companies have fallen. Yes, these companies have fallen. They have fallen now, they have fallen in the past. But look at the recovery. Just take a look at the recovery in the past cycle, right? They have recovered much faster than the index and much faster than other companies, which would be there. Similarly, in 2010 period. So that essentially what we were trying to make a point that what we should look at is the investor were curious that what kind of recovery they can see. We did a stress test. The results are here. What our philosophy says, we constructed a portfolio. The philosophy has an emphasis of having low leverage companies in the balance sheet, and the results of that are that has been shown to you, right? So results are very satisfactory, and that's why we have always been pretty vocal about it. Now the another question which comes in mind of the investor today is that whether it's right time to invest or no. Now while I have I have limitations in terms of talking that whether it is the right time or wrong time, what I can do is whenever there is a confusion, let's look at the data, right? What does the past data says? So in all the past periods when there has been fall, right, and there has been fall where the gap or the dispersion from the mean, right, has been phenomenal, right? The today, like 2008 also, there was high dispersion from the mean return, right? Mean fall. So mean fall is the mean return of index would be about 13% and 12 to 13% historically, and the mean would be the standard deviation. So one standard deviation or 2 standard deviation would be the dispersion, right? So when I'm talking of mathematically or quantifying it, I'm saying, I mean that, right? That historically, if the market has given 13%, 12 and a half, 13% kind of a return, the standard deviation from that mean should be about 12%, 12 to 16%, which is the, I think 16% is the current standard deviation as we speak of Nifty. So it should have deviated minus or plus so much from that 13% return is what we're trying to say. So if that would have deviated, then from the peak, then look at the follow through 12 months performance, right? The 6-month, 12-month performance in most of the cases, right? Most of the cases has been in green. So look at the 6 to 12 months performance in most of the cases has been green. Like now look at the 2008, right? 2008, the which is more similar to this, or 2018, which is more similar to this, right? Financial crisis or the crisis. Once we have come out of the crisis, the returns has been positive, which essentially means, or what I'm trying to make a point is that the risk and the reward, so the risk which you are taking, the risk adjusted return which you can evaluate it through Sharpe, right, has been much higher, compared to a normal scenario. So that in quantitative terms, I am trying to explain to you that the risk reward has been much favorable. The Sharpe has been much higher in this kind of a scenario. Whenever people have invested, their Sharpe, has been much higher. So that brings to my last slide. So whatever I have mentioned up till now, the only risk, we should always be cognizant of the risk, right? What is the risk to whatever data we have seen? The risk is again the magnitude of the spread, right? The containment of the spread. We know so much only, we don't know so much, right? We know very limited thing, whatever is coming today. Even I know so much, Parag knows so much, you all know so much, right? And investors know so much, right? So everyone knows so much only, and there is a limitation to that. So we don't know this unknown devil, that how long this devil is going to live with us, what would be the spread, etc., and how much the lockdown would be there, right? So the risk to all this is this, but and that also that takes us to the shape of the recovery. So since the risk is this, we cannot determine what kind of the recovery, what would be the shape of recovery, whether it would be a U-shaped recovery, it would be a W-shaped recovery, it would be a V-shaped recovery. We don't know that kind of recovery, right? We don't know the shape of recovery. All we know is that past data, if you look at the data shows us that the time is good, valuations are attractive to accumulate, right? Not necessarily means that you will see immediate gain coming into your portfolio at this point of time, but the rewards of investing in this kind of a scenario and showing courage and taking allocating 10-15%, 20%, 30% basis your individual cash flows, individual risk appetite, is quite rewarding, is what the data shows to us. So with this, I will take a pause, and I would request now Parag, I would hand over the call to Parag to run all of us through his recent interactions, because while the job is done by him in terms of identifying these companies and buying them in the portfolio, he is the one who continues to have a due diligence calls and interactions with the management, and it is very important to understand from him that how and what are these companies talking in this point of time before we answer the questions which you will have in terms of sectors. So Parag interacts with these companies, and Parag can throw us throw more light on that, what is his sector views, how he is looking at, what he is sensing from these management, that how they are coping up with this scenario, and what are the forward looking forward looking views, from a perspective of the portfolio companies. So I would now request Parag to take over the call and share his view in detail about the portfolio companies. Over to you, Parag. We cannot hear you, Parag. We cannot hear you. I think you'll have to unmute your line. You'll have a green icon, green speaker icon. You will have to just uncheck that. Yeah. Uh,
Yeah, Parag, why on the right hand side there's a box
yeah,
with a
a
speaker
green
icon.
yeah.
Am I audible now?
Yeah,
Yeah,
you're
yeah, yeah.
audible now. Please go ahead.
Yeah, am I audible?
Yeah, yeah,
Yes,
very
yes,
much
yes.
audible.
Okay. Yeah, so thanks a lot, everyone, and for joining on the call. And first of all, I would like to wish you all, to you and your families, a very good health, because we have gone through some unprecedented health-related crisis, and that has brought the entire world into a lockdown from last 3 months. Uh, so it is unprecedented event. Nobody could have predicted this, and that's why we saw huge volatility in the market. First reaction of the market was immediately, even a large market like America corrected by, so Dow Jones corrected by more than 35%. We also corrected by between 35 to 40%. But then there was a huge stimulus globally, which was done by central banks. So there was a QE of around $6 trillion, and interest rates were brought down to zero. And this actually triggered a rally in stock markets and all other risk assets, because the cost of capital was brought down to zero. And so even in the middle of such a scary event, where there were so many deaths across the world, markets have managed to recover. And so now we are already 15 to 20% up from the bottom across the world. This is just due to this huge stimulus in the form of QE, lower interest rates, and of course some hopes around vaccine or some medication or some medical solution coming out. And these hopes keep coming every day. Of course, I don't pay too much attention to the small biotech companies announcing that we are ready with the vaccine. But if the credible companies like Merck, which happened day before yesterday, or Johnson and Johnson, the companies which we know, which are global leaders, or Sanofi's of the world, if these companies announce some sort of solution to this, the market will believe into that. That's what we are seeing from last 2 3 days. Of course, in US also the number of cases have peaked out. I hope it peaks out in India and soon starts to reduce. As Devi said, it is a unprecedented event, and so nobody can predict it with complete precision. But in the middle of all this, we are seeing a very good recovery in the markets. And as Devi said, the stocks which are not leveraged, the companies which are not leveraged, which are run by very clean and ethical people, which generate a lot of cash flows, at least 60% of the EBITDA. Net debt to EBITDA is below 3.5x. These are some of the ratios which I have actually come out with by looking at the markets and stocks from last 15 years. That if you buy this kind of companies, you should be okay, even during bad times. Because remember, we are in a lockdown for 2 months. So if you don't have any leverage, if you have cash in bank, if your fixed costs are low, then you will emerge very much stronger, while your other competitors will perish. And that has been the construction of our contra portfolio as well as pipe portfolio that we have bought. So for example, in just to tell you in contra, we have so many consumer stocks like Tata Consumer, Marico, Godrej Consumer, which put together, and of course Hindustan Lever, so day-to-day consumption stocks, day-to-day things which people cannot postpone the consumption of these products. In fact, there was a stock up in the month of March when the lockdown was announced. These companies have given us phenomenal alpha. Prior to that, we were positioned as an overweight in pharma. That also helped us in the month of April in Cipla and Sun Pharma, when they rallied by more than 30-35% when markets were going down. That is how, so as Devi presented in the slide, focus for strategy, where we want to buy clean companies with very good corporate governance, who have seen the cycles in the past, and they have shown that their balance sheet, cash flows and business models are resilient to such shocks. And that is why you will see the Tata Group stocks or Godrej Group stocks or Kotak Bank kind of stock in our portfolio, or I would say Reliance also, where there is a clear intent to reduce debt. And we have seen that, right, in the when we are all sitting at home, the company has brought in 78,000 crore in Geo platform. It's a phenomenal achievement. If I talk about any Indian company which is so much committed to reduce the debt. So I would say that, and so we have 8% in Reliance also. Bharti, for example, when lockdown started due to COVID-19, we increased our weight in Bharti at around 400-420 levels, because telecom was the only sector which was benefiting out of this, apart from pharma and FMCG, of course. But pharma and FMCG, at least you need a plant to run, and for that you need people to come to your plant to produce the products. While in telecom, even that was not the requirement, and everybody was sitting at home and consuming data like nobody's business. So that was a big factor for telecom. Plus, it's a business which is completely consolidated. There are only 3 players now. So ARPU price, so price increases are just the new order of the day. I'm sure once the lockdown opens up, they will again take a price hike. Bharti and Reliance put together is 12% of our portfolio in contra. Consumer, as I said, FMCG, good FMCG companies which are reasonably valued, are around 16% of the portfolio. Pharma, of course, we booked some profits because the alpha was just too huge, and overall return ratios of the pharma sector is not that great to have a PE multiple which is more than 25-30 times. And we saw some euphoric buying in pharma because of the announcement around that HCQS tablets which India was supposed to export, and which India has already exported. But actually, when we analyzed, we came to know that the profit numbers out of that opportunity was not that meaningful, while the stocks were running like anything. So we used that opportunity to trim those stocks, and we increased our weight in stocks like Bharti or Tata Consumer or Godrej Consumer, Marico, and Reliance kind of names. The other part which I want to focus is that right now, wherever, so for example, 9,200 Nifty is a PE of around 17x on FY21, after we cut the earnings by 20% due to COVID-19 related lockdown. So earning yield is 6%, bond yield is also 6%. That is something, so it is completely at an equilibrium level. So you can find stock specific opportunities at these prices, which are debt free and good clean companies, and which generate a lot of cash flows. And because the entire market has corrected, a stock like, for example, Kotak Bank kind of a stock has also corrected by 35% from the top. When we started contra portfolio, that was the time when we bought Kotak between 1,000 and 1,100, and fortunately again we got that opportunity, and we have again increased the weight there, because it is a bank with very high CASA, very strong CASA franchise, very strong and prudent lending. So I would say that, and these private sector banks are going to be a clear market share gainers, both on asset and liability side, because so many other NBFCs, so many other small regional banks are having problems. So I would say that this is a time to do stock picking. This is a time to buy clean companies. Of course, nobody can time the bottom, and nobody can say that whether we'll go and make another low for Nifty, as Devi said, because this event is completely unpredictable. But I would say that unless we see a big relapse of COVID-19 across the world and number of cases again rise, and there is no medical solution to it, or again there is a very ugly trade war between US and China, or another any Six Sigma event which we cannot predict right now. If those kind of things happen, then only we can retest the bottom of 7,500. Otherwise, due to this huge stimulus of $6 trillion and in lower interest rates, I would say that there is a very remote chance of we retesting the bottom. So that is one part. Coming back to and of course, as Devi showed in his slide, that historically price to book multiples are very good turning point indicators, and that is where we are today. Of course, we have recovered from the bottom, but I would say that we have exactly recovered from historical bottoms. In terms of EP earning yield, bond yield also, when we were at 7,500, the P multiple became very close to 12-13, and that is the so when in lemon crisis we recovered from 10 PE. So this time we have recovered from 12-13 PE. So I would say that I'm reasonably confident that if, and that's been showcased in our contrast performance. If you look at contrast performance 1 month, 3 months, 6 months, since inception, there has been an alpha of more than 5% in every time period. In fact, since inception, the alpha is close to 16% now. Of course, but your clients must have come at a later level and at regular other periods. So the alpha would not be as high as 15-16%, but it will be at least more. We have outperformed market by 5% at least. That is because of this focus 4 strategy, that we want to buy good clean companies, dominant market share companies which generate decent ROEs, which generate a lot of cash flows, and which are available at reasonable PE multiples. So we don't chase good quality companies at any high PEs. So that's why when Kotak was 1,700, we have not bought it, but when it came down to 1,150, 1,100, we have bought it. And that is the way we have done in contrast so many times. Whether it is Asian Paints, whether it is Nestle, whether it is HDFC Bank, whether it is Kotak Bank, all the stocks which are considered to be, and they are really high quality stocks, but we want to buy them at when there is some problem in the market, and that is the time then we don't shy away from buying, and we make significant weights. For example, when Marico corrected recently, very recently, corrected to 260, 270, we made it 5.5% of the portfolio at one go. Day before yesterday, when Kotak corrected, we made it 5.5% of the portfolio at one go. So that is how we function. We don't want to, the core philosophy which runs into both contra and pipe is that we don't want to miss a single opportunity of making money for our investors in good and clean companies when they are available at reasonable prices. That is a broad theme with which I work, and I'm extremely confident that this particular philosophy will always do well over a period of time, because one, we are avoiding shady promoters, and that you can always see from our portfolios. Whatever portfolios we manage in ICICI Prudential PMS, whether it is managed by me or my other teammates, we have stayed away from all the shady names or all the companies which have witnessed corporate governance issues or high leverage issues or high promoter pledge issues. In the past, we might have gone wrong in being early in some of the stocks where business cycle is taking some more time than we thought to play out. But companies which we have bought are generally debt free or very low leverage, or the promoters on whom we have invested our money, our clients' money, are absolutely clean, and that is why I keep referring this, that you will see many Tata Group companies, Godrej Group companies, Murugappa Group companies, Sundaram Group companies in our portfolio. And in contra, in past, you all know that whenever a stock like Britannia or Marico, or I would say um, uh, Kotak Bank, for example, whenever they are available at 52-week lows, or due to some problem in the market, we have grabbed that opportunity. Or I would say Dr. Reddy's, for example. So recently, for example, Motherson Sumi, because of this global crisis and COVID-19 related issues, Motherson Sumi was available at 70 rupees, and so again we bought 3% of that in our portfolio, and today it is already giving us 30% return, more than 30% return in 1 month's time. In pipe also, for example, we recently bought Vinati Organics, Tube Investments, Godrej Industries. All these companies which we bought in this correction are already more than 30% in say 1 month time. Some of the stocks which have been laggards in pipe portfolio are auto component stocks, cement stocks. Cement stocks have already started doing very well. And as Devi said, that I should brief you about some of the feedbacks which I am getting from my discussion with the companies. So cement, for example, is doing very well in the month of May. In last 20 days, there has been a volume growth of 20% YOY in cement, which is absolutely, I would say, very, very surprising thing even for the companies themselves. This demand is led by rural housing, and rural housing plus the half completed infrastructure projects, which is boosting the demand for cement sector. Cement sector is a unique sector because there are no imports here, because it's a freight sensitive sector. There's huge freight cost. 28% of the revenue is fixed freight costs, and so it cannot be imported. And so there's a huge price discipline in the sector, and so you must have seen the reports that cement prices are up by more than 5% across in pan India, and that will straight away go into their bottom line. And we have seen the companies reporting excellent numbers, whether it is Ambuja Cement, Ultratech, even mid-cap, small-cap cement companies like JK Lakshmi have reported excellent numbers in March. And it is heartening to see that in the month of May, they are recovering very well. On the auto side, for example, Maruti has said on their earning call that entry-level cars are witnessing good response. So that should help our portfolio companies like Asahi, Sundaram Fasteners, Tube Investments in our pipe portfolio, because they are principally very large suppliers to Maruti. In fact, Asahi India has a huge 77% market share in passenger cars segment. So I would say that there might be some companies where, and for example, in pipe portfolio also, stocks like Chambal Fertilizer, Kalyani Steel, this kind of companies have recovered 40% from their bottom, and cement companies are doing well. Now, as we see lockdown opening up, or I would say last stage of the lockdown, where many things will be relaxed, and only the containment zones or only few cities, few districts will be completely locked down. Otherwise, there will be many activities, and so many cement plants, so many FMCG companies plants have already started. And we are seeing the sectors, the widening of the sectors which are participating in this rally. So today, for example, auto stocks have done well. From last 3 days, cement has done well. From yesterday, banks have started doing well. So as we see gradual opening of lockdown, and of course the global recovery due to the stimulus and global lockdown easing out, we will see more and more sectors participating. And so we are doing a dynamic sector rotation in our contra portfolio also. As I told you, where we trimmed pharma when they gave us very good alpha. We bought FMCG and telecom. And then now that FMCG and telecom has given us very good alpha, we have slightly increased our weight in financials, and that to a very high quality financial name like Kotak Bank. Of course, the underweight stance on financials has helped us a lot in generating this alpha, because as you know, in the month of January, the financials weight was as high as 38% in Nifty, and that was the time we said that let us go underweight in financials, because financials is a proxy to economy. It's a highly leveraged sector, and so if your view on economy is not that great, one should be underweight on financials, and that is what we did, and that played out exactly as per our thought process. Now that we are gradually opening, now that financial stocks have corrected significantly, we have decided that at least a very high quality franchise, a very high quality deposit franchise, as well as a very prudent lender like Kotak Bank makes a case for our investment. Anyways, we are very underweight on NBFC space. We have been very cautious as a house in NBFC space. I hope I am audible.
Yes, Parag, yes, you are. Yes.
Okay. So financials underweight has helped us, pharma overweight has helped us, consumer overweight has helped us, and the other point which we focus is that the mindset with which I run the portfolio is that we are not in a very high growth environment even, and we were not in a very high growth environment even pre-COVID-19. So I don't want to chase companies which are very expensive just because in last 4-5 years they have given very good return. So that is the thought process. So that's why you will find ACC, Ambuja in the portfolio, or HCL Tech, Wipro in the portfolio, rather than stalwarts of those sectors, because we are not in a very high growth environment. So it is better to buy good quality companies, cash rich companies, low fixed cost companies, but those companies which are reasonably valued, rather than buying very high PE or high EBITDA, high price to book stocks, which are expensive just because of their past performance, but in future the growth is anyway very slow. So that is another thought process which I have, and that is how we are different from many other portfolios. And if you go through the contra portfolio, you will realize that we are, for example, Ambuja, we are significantly overweight than any other funds, I would say, or Marico, we are significantly overweight, because we find that these companies fit all the boxes, tick all the boxes of fundamental analysis, and they are cheap. They are quite cheap compared to the industry leaders. For example, Ultratech and Shree are trading at 50% more premium to Ambuja's valuations. Ambuja is trading at below replacement cost, in spite of being a very good, strong, and old brand in cement market. Same way, Wipro is trading at say 10-11 PE compared to TCS, which is trading at 18-19 PE. So I would say that that has been one of our thought process. So going ahead, of course, in India, we have seen that the stimulus which was announced by government has fallen short of market expectations. It might have helped migrant laborers and MSMEs, especially MSME part was good. That 3 lakh crore worth of new loans were guaranteed by government. But let's see how it is implemented and how it is executed on ground. But I would say that it has fallen short of market expectations. But because we are witnessing a global rally led by this huge QE and lower interest rates, we are also participating in the rally. Of course, we are lagging behind this, but we have started participating it. So as the lockdown opens, we will see further more participation. And as it is visible from last 2-3 days, many new sectors have started to participate. Mid caps and small caps have started to participate. Just for example, today, after a long time, I'm seeing stocks like Havells or Voltas coming back and going up by 5%, because because market is expecting that the last lockdown phase will be not that stringent or strict. And as on the ground level check also tells me that if you leave aside I would say very highly sensitive zones like Bombay or Maharashtra, in the deep interiors, things have started returning to normalcy gradually. So market always upfronts it, and that is why we are seeing new sector participating in this rally now from here on. And we are very rightly poised in both of our portfolios, contra and pipe, to take advantage of this situation. And we will strive to always find, as I told you, to find clean companies which are debt free and which have low fixed costs and which are reasonably valued. That's why I will just request all of you to repose your reiterate your faith in us, and we will try to do our level best to create value for all our stakeholders. Thanks a lot.
Great. Thank you so much, Parag bhai. I think that was quite an insightful session and very exhaustive one. And I think given the current circumstances that we are in, the current situation that we are in, it definitely warranted a very detailed explanation of what is the way forward and what is the current standing in the market. So we have a couple of questions here. Hello, you can hear me, right, Parag bhai?
Yeah.
Devi? Yeah, okay. So there are a couple of questions that have come here. Just bounce it off to you one by one, although we may not have enough time to take all of these questions. So okay, the first one goes like this. So your Q1 and Q2 earnings also, Q1 is definitely, earnings have got impacted, Q2 is definitely bound to get impacted, and probably even longer. So you did mention about a recovery, a visible recovery that has been happening, but still your earnings growth is still, there is a lot of haziness as far as the earnings growth is concerned.
Right.
So how does it impact the funds, and what in your very rough estimation could we be looking at some kind of a normalcy or some kind of a pre-COVID level?
Yeah, so see, basically market knows that the month of April, say from 15th March till 15th May, was a complete washout period. So most of the companies are going to declare bad numbers in the April, May, June quarter. So that is a known information to the market. So only if we see further extension of lockdown beyond, say, 3rd June, and the entire June also is washed out, then there will be a correction in the market. Market is not going to wait for April, May, June results to come to correct. If it has to correct, it will correct because of the three reasons which I told you. One is COVID-19 cases further increasing, or there's a relapse globally. Second, if trade war between US and China gets even more uglier. And third is any other Six Sigma event which market does not know, and we also don't know today. But whatever is known to the market is priced in, and that's why we are seeing a recovery today, because market knows that we are in the final stages of a easing of lockdown or gradual opening of the economy. And as we see the reports in US also, most of the parts have been opened up now. And China is completely back to normalcy. In some of the countries which suffered significantly, like Italy and all, also the cases have started to decline. So market, and plus, as I told you, most important thing is this huge stimulus which has been given. So the stimulus which has been given in the market. So I would say that due to this huge QE and interest rates being low, market is just wanting reasons to invest and invest in riskier assets. So if we open up slowly and gradually, as the entire world is doing, I think that worry is not to be. I would say we should not worry on that part.
Okay, great, got it. Okay, so the next question is, what would be your rationale and logic from here on to look at sectors and look at stocks? How would you be looking at it? Because a lot of business models are changing, and a lot of changes are definitely bound to happen. So how do you view that?
Right. Yeah, so I'll tell you. So there are so many things, and this question is very valid. There are so many things which will take a permanent hit. It will recover, it will open up. But definitely there'll be challenges in those sectors, and some sectors which are very high fixed cost sectors, where so for example, multiplexes or hotels or anything related to travel or airlines, those kind of things will take their own time, because for that the entire fear has to go away. Um, of course, there will be some rally in the stocks because today everything is completely shut. And as we open it up, there will be some recovery in the stocks. But we all know that the things are going to take their own time. Even in financials, for example, there are so many companies which have been completely, their business models are completely disrupted. For example, the very aggressive NBFCs who are growing at 40-50%, and they were not having any deposit franchises. They were taking money on short term and lending in long term. So asset liability mismatch was huge. Those kind of business models are completely gone. And the digital format, anything, and that's why we have seen this 78,000 crore coming into Reliance, right? Because market is the entire world. And in US also you see the stocks like Zoom and various other stocks which are very relevant in current environment. They are actually moving up. And just to give you one very good example is that Amazon market cap in Indian terms is around 90 lakh crores today. It is $1.2 trillion, right? While Unilever, and this is again a great company, the market cap is 1/8 of Amazon. Nestle's market cap, I'm saying globally, Nestle's market cap is 1/4 of Amazon. So the entire world is chasing a technology plays which connects with maximum customers, which engages customer, and so the entire world is moving towards that. And that's why we have seen 78,000 crore coming into Reliance in 1 month's time from the most credible people like Facebook. So that is the new trend.
Okay.
Yeah.
Sure. Got it. Okay, so we'll take the last couple of questions due to paucity of time.
Yeah.
Okay. So this question is: are pharma and FMCG overpriced now?
Yeah, so very good question. So I'll tell you, FMCG companies, there are two kind of companies. One which are real FMCG, where if you ask any, if you go and ask DMart or if you go and ask your Kirana store, and he will tell you that I cannot survive without Hindustan Lever's products. Right, and that is a real FMCG company that every day the products are used. Every day we use the products from morning to night, and the companies run very efficiently. Those kind of FMCG products. And second is a Me Too FMCG companies, and I'll not name the companies here because but they are single product companies. They have to push their products. They have to give credit to their customers to push their product. When FMCG companies were doing very well prior to COVID-19, this Me Too FMCG companies are also going up, just in the name of because they are being morphed into a consumer sector. But now post COVID-19, it is a clear differentiation. Great companies will keep doing well. So that's why, for example, Tata Consumer has given us phenomenal alpha in our portfolio. Marico is giving us very good alpha in our portfolio. Yesterday, Dabur reported numbers which were very bad, actually 14% volume decline, and still stock is up 4% today. The businesses which have very good strong brands, which have very good connect with the customers, which are very well established brands, they will continue to do well. That is my view. Pharma, of course, wherever we see that domestic franchises are very good, they will continue to do well. The return ratios in pharma sector are much lesser than FMCG sector because they have done huge investments for their US business, while that US business is not generating enough profits. And that is why on an overall basis, the return ratios in pharma sector look very depressed. So pharma sector, I would say that, and that is also recurring need, unavoidable need. So that sector will always remain good, but definitely you will have to separate men from boys, and you will see that the companies which actually deliver, which actually reduce debt, which have very strong domestic brands, they will do well. Valuation wise, I feel that these are the sectors which will be valued richly till a complete economic recovery happens. And that's what we have seen, right? In the last 5 years also, globally, the economies have struggled. And so FMCG and pharma globally has done very well. So when we see a real recovery in, say, infrastructure sector, when there's a huge infrastructure build out by government is paying on time, then you will see the other sectors taking over, and then FMCG and pharma sectors will peak out. But right now, as we speak, there is no such evidence of that happening. But yeah, of course, the telecom is the third sector which has emerged from nowhere. It's a very, very large sector, completely unavoidable sector. The use is continuously increasing. It has become even more of a staple kind of a business than FMCG or pharma, and you are having very limited competition, and so the price hikes are going to be there, and that is going to it's a huge operating leverage sector. So whatever price hikes are happening will straight away flow to bottom line. So so that is the other thing.
Okay, great. So we come to the last question. Okay, so this looks more of like a liquidity-driven rally rather than a rally based on fundamentals. What's your view on that?
Yeah. So I agree with that. So it's a liquidity-driven rally, and so see, that is why you see that and what Devi also showed, that if you are invested in a clean company, good company, you also sometimes cannot be sure that when the return will come, but when it comes, it baffles you. For example, I was not when this COVID-19 struck, I was very surprised to see that Cipla was falling like anything. Cipla corrected from 475 to 365 in the first 15 days of this COVID-19, which was very surprising. That why pharma stock should correct, and it gave us a lot of pain also, because that time it was my top holding. But then when market realized that actually this entire thing which is happening is very bad for every other sector than pharma, FMCG and telecom, and so pharma stocks rallied and Cipla went up by 45% in a month. So that is the magic of this liquidity, that if you have a genuine business which is reasonably valued, one small trigger can give you phenomenal returns. And as an investor or as a trustee of public money, I don't want to miss that returns. So we all know that it is a liquidity driven rally, and that's why we are seeing such sharp moves and such sharp volatility in the market, because it is not being completely supported by the fundamental improvement, and that's why it is just a leap of faith. So when that faith is being challenged by some event like this, or some event like Trump tomorrow tweeting that he is again restarting a trade war, the stock prices will correct significantly. But that is the time you have to be ready. You have to keep cash. You have to buy a stock like global cyclical, like Motherson, Sumi, or something in that fall, to take advantage of the recovery which can come. Recovery will only see from Lehman crisis. What we are seeing is recovery only comes after liquidity is being infused, and that's why it is completely, I would say, right to say that the entire recovery is liquidity driven. But and we have to accept it. But you have to take advantage of that volatility.
Sure. Thanks for that, Parag bhai. And I think with this, we'll have to come to the end of this session. Thank you so much, dear investors, for taking the time out and logging in. Should you have any further questions, please get in touch with your relationship manager. You can bounce up these questions to the relationship manager. We will ensure that we take it up to Parag bhai and we have your queries answered. Thank you so much, Parag bhai, and thank you so much, Devi, for
Thanks.
joining us for this webinar. It was quite insightful. Thank you once again, everybody.
Thanks.
Thank you very much.
Thanks.
Thank you very much. Thanks a lot.
Yeah.